So I guess this will be a call to order. It's dated June 9th at 5:04. First item up for review is review of the minutes from the February 5th. Any comments? Hearing no comments, do I hear a motion?
I move to accept the minutes as read.
Do I hear a second?
Second. Derek.
All right, all in favor?
Aye.
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 All right, the third item on the agenda is pensions plan and OPEB trust first quarter performance. I think I'll turn that over to Chris.
Thank you, Kevin, and good afternoon, everyone. Tyler and I trust everyone as well. Logistically, was it the motivation for everyone who has access to Amy's slide deck? And bring it up on the screen, and I'll just make regular reference, or we'll make regular reference to page numbers if that works for everyone. I know that we inundated you with on my screen 129 pages of material. I can assure you we won't go through all of those this evening, but we did want to hit some of the highlights. So if folks have access to the deck, I would ask you quickly to move ahead, if you could, to slide number, bear with me here. It is our slide number 3. I think it's
Chris, I can share if you want. I think it's been opened up.
You want to do it that way? Is that easier for folks?
Perfect.
I'm on the firm update, Tyler, just quickly. Let me know when you're there.
It should be on your screens now. If you want to tell me what slide, and then I'll go to it for you. Okay,
great. If that works, thank you. If you, it should be slide 6. Here, 2 over this one, and then I think that one right there. So just quickly for everyone, I think we had advertised and talked a little bit about this earlier in the calendar year. Despite the goings on in Q1 and all the volatility and noise, we did proceed with our planned combination with the peer firm in Chicago, DeMayo Schneider and Associates, and that transaction has happened as advertised at the end of the first quarter. We are beginning the process of thoughtfully combining the two organizations and processes and personnel. I think, as we've told you folks in the past, there'll be absolutely no changes to the service team or model. It'll still be Tyler and I working with the committee and the town. And any changes we do bring through time will really, certainly fully intended to be the best thinking of the combined firms, and it'll be done gradually so as to minimize disruption to you folks and the information and collateral that you receive. So we'll keep you posted along the way here, but that transaction did formally close, and we are combined now and working our way into a fully cohesive unit. If you scroll ahead to, if you keep scrolling down the slide deck just quickly and go, just to that slide 5, I think in the lower right-hand corner. We won't belabor this point. I know on June 9th, this group knows what's going on. It has been really unprecedented, both the downdraft in markets that really took hold most acutely in the month of March, when markets, as you know, seized up in the middle of the month. And then the re-rating and risk assets that we've had in April and May through early June today aside to some extent. And I think we obviously all know the reasons why. If you remember back, the narrative at the beginning of the calendar year was a mature, okay global economy, somewhat elevated capital markets, but again, a notion that if things continue to move along, we did have the benefit of an accommodative Fed, the U.S.-China trade deal, phase 1 anyways, and fairly resilient corporate financial health. And we thought that set the table at the beginning of the year for what could be an okay outcome. Obviously, the health crisis completely set everything on its head. And cited a recession, of course, that we're working our way through now. And on some level, April and May's stability, right, is a byproduct, we would suspect, and think you would agree with just the sheer magnitude of stimulus that we've seen, right? Whether that is in the form of the CARES Act, whether it's the Fed cutting interest rates to essentially zero on St. Patrick's Day, on a Sunday of all days, or the whole host of liquidity facilities they've put in place, now being joined by their peer banks around the world. There really seems to be no bounds on what they'll do to try to keep the economy on somewhat of a stabilizing keel, if you will. So it's been pretty amazing, and clearly investors have taken some comfort in that. If you scroll to the next page just quickly, and then I think we'll forge ahead into some of the portfolio stuff. It was obviously Q1 really tough sledding. There were not really places to hide, certainly in equity markets, as you see there. Meaningfully double-digit negative returns, really, regardless of where you were investing on the equity front. The fixed income markets had pockets of opportunity. I would remind the committee, I know you all know this, but when you look, for example, in that left-hand column at the aggregate bond index, that index is very heavily concentrated into government and other agency paper. A lot of active managers, given the narrative we talked about as the year began, were not positioned in treasuries given where interest rates were. They didn't see a lot of value there. Those are obviously the places that in the first quarter held up best. The broader landscape for fixed income investing was pretty difficult, though, even though the numbers there are somewhat mixed. So that is the backdrop on the quarter. There's a whole host of additional collateral there. I'm at the risk of it being somewhat dated. I think my intention would be to skip ahead for the group. If you could just scroll and we'll jump in and look at the portfolios quickly and allocations, and then we'll talk a little bit about some action we've taken that I know some of you participated in not too long ago. So if we could continue to scroll here. And a little bit more, and then we'll get into the portfolio stuff. This is all available to you at your discretion. I think we should be from a governance perspective, if you go to the very next page, just quickly, as a matter of protocol for the committee, just a reminder once a year that we do like to reach out, right, and catalog the investment-related fees for the program. These numbers haven't changed all that much, as you know. I think all in, we're somewheres on the order of, 62, 63 basis points, something like that. When you include investment management fees, the Wells fee, and the FIA fee. And that would put you, I think, in relatively good stead when we look across our practice and more broadly for the complexion of the portfolios, the pension portfolios, and the way they're allocated today. And the mix of managers. I think it's representative, and we would deem it competitive in a broad sense. So just to give you that collateral for the kind of the annual check-in there, there's nothing actionable for the committee this evening. And with that, if we could continue to scroll ahead here, we'll skip. I know Becky's here, so we're going to set aside the actuarial updates. I'm sure she'll bring everyone up to speed on those fronts. The last thing I'd mention here, just for the committee's edification on 22, as you know, Wells and Principal continue to bring their organizations together. We are participating in those transition calls regularly with Wells as your custodian for the pension plan activity, as you all know. Everything we've heard and indicated is that that transition is going entirely according to plan. And we take some assurance from the idea that Principal, as we understand it, will be adopting a lot of Wells platforms and systems from their institutional custody practice, trust practice, which they like better than their own inherent systems. So I think there'll be little to no change for Amy and the rest of the group at town day to day in terms of how you interact there. I don't know, Amy, if you've been listening to those calls or not, but I think everything from what we can tell is, going according to plan. So if we continue to move ahead here, so here are the portfolio, the three pension portfolios at the end of March. And then we did provide a little bit later in the deck that we'll jump to quickly here, some updated values and seeing some of the reparations that have occurred in April and more recently. So the portfolios kind of allocated here, nothing really to take away for the group, I think, other than what I would remind you on just from a strategy perspective, a status perspective. If you work your way down the left-hand column, you'll remember we do have Templeton Institutional Foreign Small Company on watch for some changes to the portfolio management team. And those changes have seemingly kind of taken hold as we had expected based on our research. So I think that strategy will come off shortly. And then I know some of you know this already. We did elevate Van Eck to terminate. And you'll recall not too long ago, we did eliminate that position from the programs and reduce the inflation protection target down to a 3.5% target. And then we elevated the domestic equity allocation up to a target of 31.5% split between Vanguard and Neuberger. The thesis around the Van Eck strategy had changed, and they had talked about a very different mentality going forward than the one we had grown accustomed to and known. So I know some of you had heard that rationale already, but that action was affected in the programs. If you scroll ahead here, if you don't mind, listen, it was tough sledding in the quarter, and you see that down in the middle of the page. We had the plans down a little bit north of 14%, which was a little bit behind the benchmark. As I mentioned earlier, a lot of that relative shortfall came out of the fixed income programs, with really all of the managers struggling to keep pace with that government bond heavy index. What's reassuring to us, and which we'll share with you momentarily, is that in the uptake over the last 2 months, their numbers have improved dramatically, and they are actually well ahead of the benchmark in the second quarter, as you would expect, as things start to stabilize. So that is the quarter's numbers through the 3 pension plans. I'm going to pause in a moment for questions, of course, or jump in, but I just wanted to be sensitive to time. If we could scroll ahead quickly, just to try to make our way through this admittedly voluminous slide deck here. Just the individual performance of the plans, and the performance is the same across the 3, right? So we can skip ahead here if no one objects. Board of Ed, Town, and the police plan details broken out separately. You see here what I mentioned earlier, right? Very clearly on this page, when you look at fixed income as a category for the quarter, down 2.2 versus what we talked about earlier, right? The broad market's up a bit. And you see that, in pretty dramatic fashion, really across the 4 managers. I've got a couple of ideas on Templeton Bond that we want to share with the committee on a go-forward basis, and some research we're doing there. But I'm going to, again, forge ahead here if we could, just to keep us on track here. And then we can give you some more detail going forward. So if you can continue to scroll ahead, please. There's a lot of detailed manager information here. I know you're all accustomed to seeing our statuses, and we talked already about those in this status for Templeton on watch. So if we could continue to move ahead here. And this is all, we can continue to go here if you don't mind, some of the statistical stuff that we keep tabs on day to day, week to week, quarter to quarter. And continue to move ahead if you don't mind. Keep going, please. We should break out here momentarily into the, here we go. So here's OPEB, and then we'll, so OPEB, right, as we all know, has a different construct with our all-indexed approach, although the larger allocation at the asset class level is similar to the pension plans. So a $15.7 million portfolio balance at the end of the quarter. And if you can scroll ahead, please, just the numbers, not identical, of course, but similar. So you see they're down about 13.7 for the quarter. and the blended benchmark down 14.2. I think as we've talked about in the past, right, there'll be a little bit of fluctuation in these ETFs against the benchmark through time. You see the longer term numbers there start to gravitate to something that is representative of the benchmark performance net the fees, which today is, I think, 19 basis points on a weighted basis. So no surprise there, right on the 10-year number you see, ironically, just or coincidentally 20 basis points. So it's kind of running a line with expectations. So if we could forge ahead here, we don't have any issues with any of the ETFs themselves for the time being. And you continue to have, right, an index diversified program at the asset class level. So if we continue to move ahead here in the deck, bear with me here, just the statuses that we've talked about, and then some of the statistical collateral in the back of the report. I don't think we need, in the interest of time, to go through this. We could continue to forge ahead here. Great, thank you. There's the 19 basis points I mentioned, just as a reminder for the committee. We should be pretty close here to the more updated information if we keep scrolling, which I think will be of greater interest to the committee. You know what we did, Tyler? I think in this actually, we actually have your stuff baked into the report, and then I think our updated stuff actually is deeper in the deck. So I would defer to the committee's preference here. That's kind of a quick take on first quarter pension and OPEB. We've got some more information for you that we can come back to, but in terms of the deck and the way it's organized, we actually have Tyler's information for Q1 back to back with ours. So if it pleases the committee, it may make sense just to have him run through this quickly as well, and then dovetail on some of the stuff a little bit later in the deck, if that's okay.
Sounds like a plan.
That's okay for the group. Okay. Do you want to, Tyler, work through your update quickly?
That's great. We put together a special executive summary, but if you can go to the next page, 62, I'll just give you a brief update on the defined contribution plans and then some of the RFQ. Really quickly, the CARES Act was signed into law at the end of March, so it allowed for more flexibility with respect to distributions. It's my understanding that the town allowed for what's called the COVID-related distribution. So anybody who's qualified based on that paragraph up top, reduction of hours, quarantine, or actually having the coronavirus would be eligible to take distributions. I don't think the loan was enacted, but people are able to take on those corona-related distributions if they do qualify for those. If you go to page 64 on the bottom, Tom, the previous page, and I won't go into it, but behind the scenes, we're looking at and have had conversations with Voya with respect to how they're managing work from home. Has there been any breaks in service? Has there been any issues from a participant standpoint, which there has not? There no significant breaks in service, given the fact that there's been significant changes to the workforce. We want to benchmark the fees, though. This quarter is our fee-focused benchmarking quarter. And so what you'll see is each of the plans, the 457, the 401A, and the Board of Ed plan, what their average weighted cost is. So on the larger plan, the 457 plan, the average weighted cost is 1.11%. Of that, 0.83% goes to the record-keeping side of the house. It goes to MassMutual, for record-keeping costs. And so we've always had a discussion about this, given that MassMutual offers a minimum 4% protection of principal option. We were always held to somewhat higher record-keeping costs than the benchmarks. As you can see, for plans at similar size, they were slightly higher. So we've had these conversations weighing that really significant minimum of 4% guaranteed with the higher cost at MassMutual. So with that, we've actually moved to do an RFQ. We've talked a little bit about this, and I'll bring you to page 68, Tom. The process was, a subcommittee met with or looked at 8 responding vendors. Of that, I think it was Mass Mutual, obviously the incumbent, AXA, Empower, ICMA, John Hancock, Lincoln, Valak, and Voya. There were obviously all of the record keeping information that we looked at, demographic information, fee information, plan sponsor services, investment flexibility, participant services, technology, all the things that go into record keeping a retirement plan. We fell on the final 3 being Mass Mutual, ICMA, and Voya. And if you can go to the next page there, based on the goal objectives of the project, ICMA came out as the most qualified option. And so, obviously this would be something that for the town to approve on. It's something that we've recommended a very conservative timeline from an implementation standpoint. So nothing that we would be rushing to. Again, this is based on lower fees, investment flexibility, improved participant services, and I think overall efficiencies. We not only did some Zoom meetings with all of the vendors, we looked at references, and actually internally the staff looked at admin and employee website, took a tour through all the admin and employee website information. And so ICMA again came out as the most qualified. We're looking to implement something as of the 1st of 2021 as a recommendation. We don't want to rush into this. Obviously, we want to be very thoughtful given the environment we're in right now, that everyone has the ability to understand what's going on and actually navigate through the new platform.
Can you talk a little bit to the cost differential between the 3 finalists?
Absolutely. So what we can show you on the next page, I think it's the benchmarking page. Yep.
Okay, sorry.
Sorry. So we go through all the fees. On 72 is the current fee, and we'll go through the 457 plan first. So this is how we benchmark the fees. So you look at, as I mentioned before, 1.11% total average cost. Of that, 0.83% is going for record keeping costs. We then show you apples to apples on the next page. If you were to keep the same funds, we recommend. We were somewhat limited with the previous platform. We'd have the ability to get access to some of the more lower cost index investment options, but we just wanted to say, okay, if we're apples to apples on a go-forward basis, same funds, with the exception of the stable value option, which is it wouldn't be available on the new platform. You can see, close to about $100,000 in savings in total cost. So it goes from 1.11% to 0.43%. Of that, 0.16% or 0.159% goes for record keeping, compared to the 0.83% for record keeping.
Tyler, excuse me, how many people are in the 4% fund?
The number of folks, I know we've looked at this before, and I can get that information for you. If you bear with me for a second here, it was on our 4th quarter deck. Bear with me for one moment. And this would have been as of the end of the year.
Okay.
We had a total of 57 participants out of 150, with balances in the general account.
And Tyler, what's the percentage of assets in the total in the stable value fund versus?
Yeah, if it's 18% in the 457 plan.
And then what is, so the stable value is currently at 4%, and ICMA, what is their recommendation?
They're at 2.6 was the last discussion I believe we had with them.
2.6. Okay.
Again, the minimum is not 4%. I mean, the minimum will be closer to 1%. So it can go down as low as that, but it is not the 4%. And as we've discussed before, the Mass Mutual, this is an old legacy Hartford product. We've had conversations with Mass Mutual about the overall fees that were going into or were paying for record keeping. They were willing to reduce that by us eliminating that 4%. So the fees were counterbalancing the fact that you had such a high 4% minimum.
Tyler, how does that work? I know in like mutual funds, the fees have to go with the funds you're invested. Is this because they're a package of funds? I'm just wondering what's the legal basis for them charging a higher amount when people don't have funds invested in that particular fund.
It's an older, at least it's older product. It's an older Hartford product that they have. The paper on it, the contract on it, could not be adjusted. They had to guarantee the town that 4% number, that 4% minimum number, and so that countered obviously the fees. So they can charge the town really whatever they want. It's a wrap fee that goes into essentially offset some of the 4% number.
And Tyler, and the new things we're looking at, part of our fiduciary duty is the preservation of an estate. Are we meeting our fiduciary duty if we change that from a 4% guaranteed to perhaps 1%? How can you explain how we're meeting our fiduciary duty with the change?
Yeah, I think the concern is that the people who are not invested in that portfolio are essentially paying for the folks that are in that. And I was concerned, given that the fees are so high, for someone who would be in maybe something that's more appropriate for them. A 4% annualized, given someone's career, is just not going to get you to retirement. If you talk to pundits, they're thinking more 6-7%. If I'm a early career individual and I'm more heavily in equity, I'm offsetting those folks in the stable value option or the guaranteed option.
I get that, but how do those who are in the stable value, how are they going to benefit from the change?
They won't, obviously they won't have that minimum. The fees overall will be lower. So if they have assets outside of those investments, net the fees will be lower for them as they're invested in the other mutual funds.
And Tyler, this is Derek. To be clear, any new entrants into it do not have access to the 4%, or is...
That's correct. It's
yeah. So that's where the fiduciary to everyone, not just the select group, I think is part of the answer as well.
It's just the 457 plan. The other plans do not have access to that 4% minimum. They just won't make that available to folks. We've actually over the years. Sorry, Lisa. Derek, go ahead.
I was just going to ask Maria if our unions, are they aware that the town is considering this change, and have they been consulted?
So at this time, it's not something that I've been working with them through, but it's something that I can, certainly update them on.
We go through the other plans in the following pages. So on 674 and 75, you can see what the 401A plan looks like and the change there, as well as the Board of Ed plan. Again, just slight difference in asset allocation, but overall, the result of the project, pretty significant overall savings. Obviously, we did take into account and we did look at the stable value offerings within all the respondents. ICMA was one of the more competitive stable value options. We didn't get anything obviously close to that 4%. And to be candid, the Mass Mutual were not their proposal did not include that 4%. The only way you could get the 4% is if you stay put, essentially, with what you have.
And what does that translate in dollars to an average investor in our plans?
The cost savings?
Yeah.
So when we look at the per head number, just on the 457 side, record keeping cost is $676 per head. It goes down to $129. Now, again, people are invested differently, but it's roughly a $500 plus dollar savings per head. Now that's just on an average number. And what you can get that number, Tom, if you go to 72 and then 73, that bottom right corner number is the per head number. So we just take that total record keeping costs received. We take it by the number of participants, and then you can see the same number there based on the same participants, but it obviously lower per head number.
And that's part of the basis why you believe the prudent investor rule would be followed with your recommendation.
Yeah, and when you look at litigation, to be candid, it's been more fee-based than investment-based over the years. Not to say that there's an issue there. It was because every year it was benchmarking a little higher than we wanted to. And obviously there's a rationale behind that, and we've discussed that rationale given the 4%. But I think given the environment now, it just would make sense to move towards that lower fee. And now actually when we benchmark, the total average weighted cost would be lower. The record keeping costs would be lower. And we've been a little bit handcuffed with the current platform with respect to the investments. We'd be able to get access to some lower cost index investments, some lower share class target date fund investments. We'd have a little bit more flexibility. And I think overall, it was very close at the end with respect to participant services and efficiencies. But I think the end result was that this made the most sense. It was
So Tyler, so it's fiduciary's recommendation that we go with ICMA.
That's correct.
Okay. So I think from my understanding is then we would need to move this on to the full Board of Finance in order for them to vote on it. So I would just need a motion to make the recommendation.
Yeah, this is Derek again online. I move that we acknowledge FIA's recommendation and further recommend to the Board of Finance replacing Mass Mutual with ICMA.
I'll second that. This is Tom Potter.
All in favor?
Aye.
Aye. Opposed? All right, so the motion passes. Now, I just want to compliment both Tyler and Maria and Amy for all their hard work and putting the RFQ together. It was a lot of work, and especially putting it together via Skype and Zoom. It's been a little bit of a challenge. So I just want to thank you guys for all the work.
So for purpose of time, we don't have a recommendation for, and I appreciate that, Kevin, first and foremost, and I know Kevin was a part of those as well, and I appreciate that effort. We don't have recommendation to change the menu. That being said, given that we have a little bit more flexibility, for instance, we can add additional target date funds, the 5s as opposed to just the 10s. we can look at Vanguard index options. We'll have a proposal come the September committee meeting for a full lineup, so that we'll have time to implement that come January 1st. It's not obviously something we're looking to wholesale change, but it'll be share class, lowering certain share class investments, and adding additional target date funds as well as the index options. But
Tyler, so you'll bring that forward in front of the Board of Finance to approve the menu selection of investments?
That's correct. We obviously didn't want to bring everything today and discuss that, but we'll have a full menu available for the Board of Finance to approve.
Okay, thank you.
Unless anybody has additional questions, I'll pass this off to Chris. Do you have some additional material on the pension? Oh, you're on mute.
Thanks, Tyler. I'm sorry. I was going to very quickly, Tom, if we could scroll ahead here. I just wanted to leave the obviously a pretty dour first quarter for investing, but an appreciably better one in the spring. And if we could scroll back towards the back of the deck just quickly, I wanted, if the committee will grant me just one more minute, scroll all the way down here through Tyler's information. We do have some flash reporting. I promise you, we're getting through the disclosures. If you keep scrolling, we did that already, so that was just another update. If you could keep going and stop right on that page, if you could. Thanks, Tom. So the portfolios, as you can see there, if you do a comparison of kind of where we were and where we've come to, these balances are as the end of May. You can see the uptake across the three plans has been pretty dramatic. I believe the portfolios were each up about 7% in the month of April. We're a day or two away from the May flash, but I would tell you that the managers, or particularly the fixed income managers, are appreciably ahead of the broad markets and benchmarks for the full quarter, with even more momentum in their relative results in the month of May. And that continues to an extent along the entirety of the equity managers as well, with the strategies up. This is the type of stuff, right, that you just can't make up. The lowest performing strategy in the second quarter, emerging market Vanguard, is up over 20% in the quarter, all the way up to Newberger, that's up close to 30%. Many, the two of the fixed income managers up north of 6%. When the broad fixed income market is up about 1.8% for the quarter. So, fingers crossed here, but certainly there's a lot of momentum with the managers now that markets have stabilized a little bit. Better results in the month of April, as I mentioned. And you see that in the recovery in the balances over the last couple of months. So we're somewhat encouraged by that. I failed to mention, but just as a reminder to this group, some of you will remember we did have the call back in March, and the action was taken to rebalance some of the fixed income overweight into equities. And that has certainly, given what equities have done vis-a-vis fixed income, been additive to results recently as well. So your thoughtfulness around that exercise, I think, has been rewarded as well. So that's encouraging. And what I would leave the committee with, we are doing some work under the hood on Templeton Global Bond. You see there, it's one of the satellite mandates within your fixed income program. We'll have more to come in short order here, but just evaluating the team and that strategy there, and on a go-forward basis, if we think it continues to make sense to hold. And I say that cautiously because we do continue to rate the strategy as maintained. It's just under the hood, giving some thought to fixed income more holistically and what might make better sense for the committee to consider. And again, we'll be back to you with that detail in short order. But otherwise, I just wanted to give that updated information to the group. So a much better Q2, which again is somewhat comforting on the heels of Q1. And that, Mr. Chairman, is all I think I had in terms of the second quarter preliminary updates. And again, happy to take questions from the committee or feedback or anything that you may have.
Okay. Any questions for Chris or Tyler?
I just have one question for Chris. As far as the active manager's fees exceeding like ETF fees, do you think the value in active management is still there?
It is, Tom, the question that our research department wrings its hands out, as you can imagine, more than any other. And I know we've talked about this a number of times, and it's an important question, and it's one that the committee should be asking. We do continue to think in a market that's more dispersed and not top heavy with the glamour names and U.S. exceptionalism and all that kind of thing, and on a go forward basis, there is a place for some thoughtful active management. As you know, we're not inclined to do that in large cap U.S. equities, and that's why you've got the Vanguard index. So we're kind of mixing and matching as thoughtfully as we can, and we would answer to you that yes, we do think that there's a place for both. We're seeing it right now pretty dramatically, as you know, in the fixed income space and the take back there. And I think we'll see it with equity managers also. More consistently as the breadth in the market maybe spreads out a little bit. We do think that there's an opportunity for some rotation and better relative results for the equity managers. It's certainly something I can assure you we spend inordinate amount of time on with our research group and pressing them on that. So we don't want to take exorbitant amounts of active management risk and spend too much, but I think the mix you have today kind of reflects that balance as best we see it on a go forward basis, if that helps.
Thank you.
Any other questions? All right, hearing none, then we'll move on to the sixth item on the agenda, which is a discussion of the tiered discount rate structure for the pension plans. I think the impetus for this discussion is just to raise a couple questions. I shot over to Chris a question about the Wisconsin retirement system. They take a little bit of a different approach to managing risk. Their long-term, at least from what I read, it might have changed, but from 2017, their long-term return assumption was 7.2%, but their discount rate was down to 5%. So what would happen is if returns exceeded 5%, they were allowed to put that excess to use to increase the annuity payments for the retirees. If the return assumptions fell below 5%, the retirees weren't affected. So it was an interesting idea. I just thought it would be to get some more information on it is what I was looking to do, rather than for us from a Board of Finance perspective, always adjusting our discount rate as we went just through the exercise recently. So I think Becky is.
Yes, I am. It's good to talk to you today. We're very familiar with the situation in Wisconsin. We've done a lot of work with the state of Wisconsin on their retirement system. This is not a difference in how they determine the appropriate interest rate. It is a different plan design. I would describe it as a variable annuity design. Some of you may remember that I came and talked with the retirement board a couple of years ago about something we call the sustainable income plan, which is another kind of variable annuity design. But after retirement, benefits that retirees receive are subject to investment risk. So if investments outperform certain benchmarks, retirees' benefits go up, and benefits for retirees can also go down if the investment return is poor. So for the actuary calculating the liability for the plan, based on the specific parameters of that arrangement, it's appropriate to use a discount rate of 5% to calculate the liability. That's not a statement about how the investments are structured necessarily. It's a statement of how the benefits themselves are structured. A variable annuity design is a very interesting concept. In the sustainable income plan variation that Milliman has designed, for instance, the plan is always 100% funded, because as investments do well, benefits go up. If investments do poorly, benefits either go down or are shored up by some sort of a reserve fund mechanism. I'd be happy to talk with you more about that. But it isn't, I guess, to repeat myself, Kevin, this is not a statement about how the interest rate assumption is set for a garden variety plan. This is a very unique kind of plan, and the interest rate is set according to very different sorts of things than we think about when we're normally talking about your interest rate assumption. There is a local variation on the theme that I think you should, well, I want to bring to your attention so you're aware of it, and that's what the town of Glastonbury does. They have bargained a hybrid pension approach for some of their town unions who are hired in the past couple of years. The hybrid approach is a modest defined benefit plan coupled with a modest defined contribution plan. So there's a sharing. It's not all or nothing. Employees are covered by one of each at the same time. So there's a sharing of investment risk to the extent benefits are paid for through a DB plan. The town is bearing investment risk, and to the extent employees have DC plans, the employees are bearing investment risk. But what the town coupled with that is, and Chris knows all about this because he's in charge of it, is that the assets that back the DB portion of the hybrid plan are more conservatively invested than the bulk, the legacy, old-fashioned defined benefit plan. And because there's a more conservative investment stance, we have a lower interest rate assumption to go along with it. So it's a more conservative approach, but the idea is that long-term, as more and more employees are in the hybrid plan rather than the legacy plan, that the town is taking less investment risk. It will cost more to provide the same benefits by having a lower expectation about what future investment returns will yield.
Okay.
Did that help, Kevin?
It gave me a little bit of a frame of reference. I mean, I think it would be interesting just to see their plan design and a little bit more information about how they're structured. Is their interest rate assumption that drastically different than ours? Because
Glastonbury,
yeah,
we have the same conversation with them as we've had with you in terms of lowering the interest rate assumption for the legacy plan. And we could continue to move that down a little bit. It's in the same ballpark as yours. The investment profile is in the same ballpark as yours. In the upper 6% right now. The hybrid plan is 5%.
So I have a question for Becky or somebody. If you move to a different design model like that, is there any impact on what the actual obligation is based on the contracts with the employees of the unions as to what amount of they will receive and over what period of time?
Well, all benefits are collectively bargained except for the unaffiliated employees in the town plan. So any changes that were made would have to be collectively bargained. What we typically see is that benefit changes are bargained on a prospective basis. The easiest and simplest way that that happens is that new employees hired after a certain date have a new benefit structure. Sometimes, though, changes are bargained for on a prospective basis for current employees. For instance, the Board of Education benefit multiplier increased from I want to say 1 3/4% to 2% for service after 1996, I think it was. So the benefits at that time were increased prospectively. You could lower benefits prospectively as well. If you wanted to explore, for instance, moving to a sustainable income plan, you could make that a purely prospective new employees only, or have some mechanism for implementing it on a prospective basis for the existing employees.
So just to ask the same question a slightly different way, if you're going to change the design of the plan to share the risk with between the town and the pensioner, is it done at the same time that you would negotiate what the total payout would be? And isn't the payout usually a percentage of the last highest periods of pay for a period of time? So those, I guess, can you meld those together, marry those together?
The benefit provisions determine the benefits that employees will get when they retire. So it's one and the same thing. If you change any aspect of the plan provisions, that changes the future benefits that the plan is expected to pay, which in turn changes the liability and changes the town's annual contribution.
Okay, thank you.
Well, thank you, Becky.
Yeah, I did. If you could just give me a couple minutes, there were a couple of things I did want to mention to you since I have you all here. The first is that Chris and Tyler mentioned before, the CARES Act. There has been some legislation already. There's more in the works. There was a large bill, as I'm sure you know, that passed the House and is sitting with the Senate. If and when there are any changes that we think will impact the Simsbury plans, defined benefit plans, we'll let you know. But the relief is largely geared towards corporate pension plans, not public plans. So, but we'll let you know if anything happens. We are doing monthly updates rather than quarterly of the public pension funding index. That's one of the things I do for Milliman. It's looking at the funded status of the 100 largest U.S. public pension plans. Our end of May update should hit the press in the next couple of days, because it was good news. The press actually would rather report bad news, but we wanted to get some good news out on the street. We also started a new publication called Dear Actuary, which is geared at answering really straightforward questions that taxpayers and elected officials and members of pension boards might have. We're trying to provide just very straightforward education. So if you just use your search engine to plug in Dear Actuary, you'll find a couple of Dear Actuary articles that have to do with things like how is the market downturn going to impact our pension contributions? If you have any questions you'd like us to answer, there's a way to send in your answers to us. I'm hopeful that by the time we get to the end of this month, the recovery will be complete and it will be a decent year, but I have to expect that we may not get quite back to a really shiny fiscal year end return. So chances are we're looking at some sort of an asset loss for the current fiscal year. So I suggest that as soon as Chris has the year-end numbers, that you have us start running some estimates so that you get a heads up in terms of what next year's contribution might be looking like. There are a couple of things that you did not do with the 2019 contribution. We did not lower the interest rate assumption. We did not update the mortality table, and those things need to happen in 2020 in some fashion, and you may also be having to absorb some as yet unknown asset loss. So I think it would be, I think Amy and Maria are going to want to know what those numbers look like sooner rather than later. So I suggest that we start just doing some estimates in July, August timeframe before we have the updated census data and have real numbers. We can get you most of the way there and talk about things that we may need to do in order to mitigate the impact on the town's budget.
And Becky, correct, the interest rate assumption, it's about $1 million for every quarter that we adjusted. Does that sound about accurate?
I don't have those numbers in front of me, but it's not nothing. You know,
Right.
every 25 basis points or even 10 basis points hurts, but so we need to talk through what's going to be doable. You know the bigger financial picture, Simsbury better than I do. I'm doing my best to support your local businesses. I live in Granby, so we do what we can, but it's going to be a hard budget year. So we want to have the numbers in front of you as soon as we can so that we can talk about what do we do.
Okay. Any other questions for Becky? No. All right. Then we'll move on to the final item, the review of the optimization schedule and alternatives.
I'm sorry, I don't have my agenda in front of me. Is that me also?
I think that's correct, yeah.
Okay. Well, FIA and Milliman put on a webinar a couple of weeks ago talking about different strategies for coping with a potential market downturn. And you already do a lot of the good things. You use that asset smoothing mechanism, and that means that you don't feel the good news of a good year all at once, and you, more importantly in today's context, you don't feel the bad news of a market downturn all at once. We smooth market gains or losses over a 5-year period. So if this month ends on an abysmal note, take comfort that abysmal won't hit you all at once. You'll gradually feel it over 5 years. But the other very important thing that you can do, you can contemplate doing, is lengthening the amortization period. At July 2019, we were down to 14 years, which is a great place to be. So that goes down by 1 every year. When we get to the 2020 valuations, we'll be at 13 years, which is a very nice relatively short period. So 13 more years from now, 2033, the plans should be fully funded, all other things being equal. But that does mean that if there are large market losses, even with asset smoothing, that's a relatively short period of time over which you're amortizing the impact of the market loss. So you may want to consider extending the amortization period. We started at 25 years in 2008. For those of you that were involved back then, we were 25 years. It's gradually been worked down to 14 and now 13 this year. We could go back to 15 or 20. We'll be able to play around. This is what we recommend doing over the summertime. Play around with what the numbers are likely to look like, both with the market downturn potentially and with an updated mortality assumption, and we'll be able to tell you then what kind of an amortization period would result in no change to the town's contribution or a modest increase in the town's contribution. We'll know better once we have the year-end numbers and can play around with it. We may also want to get a little fancier than we've been in the past. You may want to stick with the current amortization schedule for everything that happened prior to this year, but have a longer period for recognizing the impact of a market downturn and or the mortality table update. So we'll be able to, we'll take a look at it first, play around with the numbers. I mean, that's what we live for. It's a cool spreadsheet. We'll play around with it and then come back to you with some ideas and see how you're doing, see what your picture looks like, see how your tax base is faring, and then come to some conclusions about the appropriate way forward for you.
Becky, this is Tom Potter. At the 13, 14 years amortization of the liability, how do we kind of stand in relation to other clients you work with?
Pretty typical. It was very typical in 2008 for many of our municipal clients to lengthen their amortization period to deal with the impact of the financial crisis. But different communities reset at that point to different time periods. So you went to 25 years at that point. Others of our clients went to 20 years. Everyone was a bit different. We do have some clients that have worked their way down to 10 years. Once we get to 10 years, we shift gears a little bit and use a slightly different approach. Anything shorter than 10 years actually introduces too much volatility in the contribution. We don't like that. So we have something different that happens when we get to 10 years. And we have 3 or 4 of our several dozen Connecticut municipal clients that are in that boat. There are a couple of communities that have gone to that well a couple of times and have reset the amortization period, have lengthened it in response to various things, and they're already long, and we can't get longer, so their backs are up against the wall. I like where you are at 13 years coming up because you have options. That's a good place to be. You're relatively well-funded, not the best, but by no means down at the bottom of the barrel, right in the middle of the road. So we'll have some flexibility. I think we'll be able to come up with a package that you'll be okay with without too much difficulty. Lengthening the amortization period is a trade-off, of course. Longer means it will take longer before the plan is fully funded. Shorter is better in that regard. You want the plans to be getting to fully funded, but you have to be thinking about your bigger picture, the financial picture, the strains that your taxpayers are under right now.
At some point, you have to face reality that we can't afford these plans much longer.
Well, yeah, we don't want to completely ignore them. In my line of work, probably the single most common phrase I hear in this regard is kicking the can down the road. You do want to think about which generation of taxpayers should be paying for the benefits. So that's an argument against a very long amortization period. You're really having the wrong generation of taxpayers pay for the services that they're getting from today's employees. But there's a balance and you are the ones who are in the best position to figure out how you want to manage that balance.
And one question, Becky, do you hear of any towns or cities that are actually would borrow to fund it more, given the rate environment?
Yes. Chris and I are working on that with another of our joint clients right now. I spent most of the day working on a stochastic model to help them analyze that situation. A pension obligation bond has a bunch of strings attached to it. It includes some state oversight. You have to get permission from the OPM and the Treasurer's Office or approval from them. It's a taxable bond, so the rates are a little bit higher than your general obligation bonds, but they're still, last I heard, in the low 3s. Right. And if you can borrow in the low 3s and then invest in the pension fund and long-term earn, low to mid 6s, there's obviously an arbitrage opportunity there.
Well, would you be able to kind of maybe keep us up to date with what that process is? I mean, I think it's an interesting idea from.
Yeah, I've done this with a couple of other communities. I'd be happy to talk you through it in more detail.
Okay.
There were a number of pension obligation bonds that were issued just before market downturns, and that's absolutely the wrong time to do it. I think the Connecticut State Teachers Plan did a pension obligation bond it was either in 2000 before the dot-com bubble burst or in 2007 before the financial crisis, one or the other. And like, it's just absolutely the wrong time. So if we think that there's going to be a market correction in the near future, you don't want to borrow money and invest it before that happens. Having said that, then March would have been an awesome time to have done a pension obligation bond.
Right.
But that ship has sailed. But we highly recommend that you do some really robust analysis to make sure that you are comfortable with the risks that you'd face, because you have to pay debt service. You don't have to pay your pension contributions. You ought to pay your pension contributions, but you don't have to in the same way that you have to pay debt service. So it's a serious conversation, but I'd be happy to walk you through it in more detail.
Okay, thank you. Any other questions for Becky?
Becky, I have one.
Sure.
I think it was 2012, although I could be wrong. I think you did an actuarial experience study for the town, and that ended up with net savings to the town as we got truer to our actual costs. Can you give me your thoughts on whether that's advantageous for us to think about?
It's a best practice to do an experience study every 5 years or so. Many plan sponsors don't like to pay for them, to be honest, but that is a best practice. So you're, a little overdue for one. I cannot in any way, shape, or form guarantee that a new experience study will result in lower liability versus higher liability, but we do want our actuarial assumptions to be doing the best job they can at anticipating what's coming down the road. And if what's coming down the road is bad news, better that you know about it sooner rather than later. So an experience study, most importantly, will be looking at how patterns of turnover and retirement and pay increases have changed over the past couple of years relative to what we saw longer ago. I'm sure I've told some of you this before. I'll always be happy to spend your money. But this I actually think is really money well spent. It doesn't cost all that much. And, you have a lot of millions of dollars of liability and assets and contributions. And I think it's in everyone's best interest that they be the best numbers we can make them.
And then just one more question, Becky. Have you seen other towns close their pension plans for unaffiliated at a date certain, so they get everything in the past but close going forward? And how does that impact the ARC and funding when that happens? Is that something to consider?
Lisa, that's been a constant topic of conversation with municipal pension plans for the past 20 years. It's probably the most frequently bargained benefit change is to close the defined benefit plan to new employees and have them covered by a defined contribution plan instead. The pendulum has been shifting a little bit on that, and increasingly what we've been seeing in the past couple of years is not a complete shift from defined benefit to defined contribution, but rather a shift to the middle ground that's a hybrid plan of the kind I described before that Glastonbury has, West Hartford has, a bunch of communities have been moving to that. Defined benefit versus defined contribution is kind of it's a barbell, right? Like the two extremes. And a hybrid plan represents a middle ground, a compromise, if you will, a sharing, not an all or nothing on investment risk and longevity risk both. So we see a lot of all different flavors of both of those approaches. In terms of unaffiliated employees versus collectively bargained employees, in most communities, the unaffiliated employees follow whatever is bargained for the appropriate union. So there are only a handful of places where there are different plan provisions that apply to unaffiliated employees. And Simsbury is one of those places. So, but you're a little unusual in that regard.
Thank you.
Any other questions before we move on to the last meeting on the last thing on the agenda? Do I hear a motion for the last agenda item?
This is your meeting, Kevin, or I do it. That's for damn sure.
I can't make a motion, can I?
Yes, you can.
I make a motion to adjourn.
Second.
All right.
Favor, aye. Thanks, guys. Appreciate all the help.
Nice seeing you
Thank you.
all.
Thank you, folks.
Thank you.